Greg Carter, take it away.
Absolutely. Thank you so much, Patrick. I'm really delighted to be here and for your final Connect session of the year. It's a real honor and wonderful to meet everybody from right across the world. So very exciting. The wind and the rain is really whipping around my house, so this feels like the perfect conditions for a cozy fireside chat. Just a little bit of background about me. I'm the CFO at Capdesk. We're a SaaS company that helps companies across Europe digitalize, automate, and simplify equity management. So that means keeping a record of your shareholders, managing employee equity schemes, and even running equity transactions like the digital issuance and exercise of options, warrant schemes, etc., and even processing secondary transactions, which are becoming increasingly popular. And prior to Capdesk, I spent about 10 years on both sides of the table. So first, as an investor in early stage companies for a corporate VC and then a family office. And then I ran an SME lending business in the UK for that family office. So I've actually spent a lot of my career wrangling cap tables, setting up and running employee equity schemes, and ultimately trying to promote that ownership mindset, which I think is so important and such a compelling reason for issuing equity to employees in the first place.
Wonderful, thank you. Just to finish the kind of introduction to the session before our first questions, to let you know, someone's going to ask, so yes, we are recording, and yes, we will send out the recording to everybody who registered, whether or not you are here. Of course, if you are here, you are here, so hopefully you don't need the recording as urgently as some others. Second, you will have seen, and many of you have tested out the chat function. That's fantastic. Please continue using that. You can react to something Greg says. You can have a conversation amongst yourselves if you'd really like. Next to it, you'll see the questions function or the questions tab. Please ask any questions that you really want Greg to answer there, because it's just much easier for us to find them if they're in the question section than in the chat tab. Cool. So with that said, I'm going to ask the first question of Greg, and also please ask them at any point. Just keep them coming in. We'd like this to be a nice back and forth conversation, and we really want to make sure that we're talking about what you want to know about more than the questions that we've prepared. But let's begin with one of those prepared questions, and I think it's there's certainly a hot topic, a trending conversation happening in the world, all over the world at the moment, around the Great Resignation, around people basically choosing to leave jobs, not being let go, choosing to leave jobs. And often it's not because they are, from what I've read, it's not because they're quitting just because they're fed up with working or because they've had personal issues and all that sort of thing. It's because there are better options available to a lot of skilled workers at the moment, and people are starting to realize that. Could be more remote work, could be different responsibilities or opportunities, and it could be more equity. So with that in mind, how does equity kind of play into the typical dynamic in terms of keeping employees satisfied, happy, engaged, thriving?
Absolutely. It's a really important topic at the moment, as you say, and one that we find is increasingly on the minds of our customers and other CFOs I speak to. Clearly, if an employee is unhappy with their role, equity won't be the only component that will keep them in that position. But I think equity plays a really important role in giving people a form of long-term incentive. So salary pays you month to month. Equity not just provides you with a view of compensation over many years, but it also aligns your interests as an employee with that of the company in a very direct and tangible way. Suddenly, as an employee or as a manager, all of those KPIs and health metrics that a company is trying to target, with the right communication, you can become a lot more motivated behind those if you understand how your actions will contribute to KPIs, which will then contribute to share price, which then contribute directly to your compensation. So I think equity is one of the most powerful levers to both incentivize and retain employees over the long term, and provide a really direct, tangible link between their activities day to day and the success of the company.
I've been in a few companies personally where I've been there the day that equity was brought in, or when equity was brought in for employees, and you have a really fascinating dynamic where for the first, say, 3 months, it's sort of all anybody's talking about. Everybody, obviously, it's very exciting. Everybody believes in the company and the project, and so now having a stake in it is really great. And then you sort of see that over time, people talk about it less and less, and everything goes back to just being a job. How do you keep people invested in that concept that they have equity in the company?
As you say, it comes down almost entirely to communication. The management team at the company need to be continually drawing that link between the performance of the company and the value of the share price, so that always at the back of an employee's mind is this sense of my actions will translate to share price growth. And a lot of companies, that can be quite challenging to do, both culturally, because perhaps there's a risk of creating quite a mercenary attitude if people are very conscious about always drawing links between performance and share price. And also, perhaps some companies don't necessarily have a good idea what defines the link between performance and share price. But nevertheless, I think moving more towards that form of communication on a recurring basis. So as companies start to maybe think in terms of quarterly OKRs or other performance objectives on a quarterly basis, just being able to take a moment within the wash up for the quarter to say, okay, this is how we've driven our performance, and this is a potential link to share price. I think all of that just keeps that conception of equity bubbling at the back of people's minds. And then I think beyond the communication element, and apologies if this is a shameless plug for a platform like Capdesk, it's being able to give employees some tangible sense of ownership. So it's one thing to send out a letter to people saying, oh, you've been given this equity grant, congratulations, it vests over 4 years. It's another thing to be able to give people a portal where they can log in and see exactly their current position, see how their shares have vested over time, and perhaps even see some simulations as to what the current value might be.
I think that's a really interesting point, because typically, I think you have on the one hand the kind of startup lottery where people are joining and sort of hoping that within 2 to 3 years, or maybe 4 years, the day that their shares are fully vested, the company IPOs and everybody walks home with €1 million each. Obviously, in the vast majority of cases, that's not what happens. So giving people that kind of tangible, realistic viewpoint on what really is happening, particularly in companies that haven't yet gone public, that's how you see the best way to sort of keep them engaged with equity.
Yeah, absolutely. And the market's constantly evolving here. And a trend that we've really started to see this year is around the growth of secondaries. So this is companies that are still private, that are still on a capital raising journey, but increasingly, such is the weight of investor demand, that there's increasingly scope now for slightly later stage companies, maybe at the B+ stage, Series B+, who are tagging on secondary transactions alongside new primary issuance. And where that becomes really exciting is you get to take away some of that lottery element to employee equity. So those early employees who've maybe fully vested can get the opportunity to sell some or all of their equity in a secondary, and suddenly equity becomes real, it becomes tangible, it's been converted into cash. And I think that increases the perceived value, not just for those employees who've transacted, but all of those other employees who are at the company and who are vesting their equity. We're working with a client right now who's setting up an annual liquidity window for their employees, and that really shifts the game, in my view, from options being a lottery ticket to options being part of your compensation package, where you can really see a tangible link between increasing value of the company and your own compensation.
I think that goes directly to the first question that we had from the audience, which is exactly as you're sort of as we hinted at. If the company never goes public and the potential is just IPO or nothing, then of course in a market where the chances of an IPO or the company going public or being bought or whatever, an exit, are very slim, that doesn't indeed basically take away all of the potential excitement around equity. But what you're saying is that there are other options to create shorter term windows for gain.
Absolutely. So firstly, it's not IPO or nothing, and certainly most of the employee option schemes that I've come across have participation on any exit. So if that's a trade sale or an exit to private equity buyers or IPO, all of those would allow staff to participate. But as I say, one of the newer and more exciting trends that we're seeing is this ability to create recurring liquidity windows, where as a company is going on its growth journey, there are opportunities for those early employees to take some money off the table and realize the value of all their hard work.
So just so I can make sure we close this loop, that's sort of what you would suggest as the best tactic for keeping employees engaged in the concept of equity, or are there other good examples that you could share similar to the one that you just said with the yearly window?
So yeah, I think allowing employees to turn options into cash is clearly the gold standard for helping everyone at the company realize the value of the equity. But that's just one strategy, and I think there's a lot that can be done with really effective recurring communication. And so whether that's communication through company quarterly updates and other management updates, or whether it's communication through employee option portals, a regular cadence of communication around equity is crucial to keeping people engaged. Just in the same way that you're regularly communicating with your shareholders about how the value of the company has improved as a result of good financial performance or reaching other milestones, exactly that same communication to employees can help people keep engaged.
And just while we're on this topic, we've had another good question. Aren't there restrictions on employees in terms of taking their stocks to secondaries?
So that depends. So that depends on the scheme. It can be the case that scheme rules prohibit that. So in the UK, for example, some EMI schemes, so EMI is a very popular tax-advantaged option scheme in the UK. There can be rules within those schemes that prohibit secondaries, but that's in the scheme design. So if you're a company that is planning to go through secondary transactions, you can adjust your scheme accordingly.
I have a very basic question, maybe just at the table. I hope it's not basic. Can a company design any equity scheme that it wants, essentially?
So the short answer is yes, but the tax man might have some views. So across Europe, there are differing rules around what schemes companies can offer on a tax-advantaged basis, and in some countries there are no tax-advantaged schemes, and that's why you see fewer equity schemes being offered. I think it's well recognized that the UK has some of the most generous employee equity schemes available, and they do allow you to create a really broad range of scheme parameters. So when we're talking about parameters, we can be talking about everything from the amounts that people are granted, the strike price. So that's the price at which employees have the option to buy their shares. In some schemes, that can be granted at close to zero and still qualify for tax advantages. And obviously, that means that employees are getting not just the gain in share value from when they were the options were granted, but also the value of the shares at the time that they were granted. You can also design very creative schemes with performance-based milestones for vesting and other performance kickers. So yeah, it depends really on the country and what you're trying to achieve. But in general, you can design some very creative schemes.
I asked the question mainly to understand whether the majority of, for instance, here in France, most companies are, that I know of, most sort of startups that are on a similar scheme, BSPCE, everybody knows it, we all use the same thing. And I assume, aside from legal reasons, administratively, it's far simpler just for us all to be on the same scheme, because then we can just do what they're doing and they're doing and they're doing. Is that sort of the way you see it as well?
You mean well? So there's the type of scheme and then the rules within the scheme. And I think it's the rules within the scheme where different companies have different preferences that link back to their philosophy about equity. So that could be about who gets access to equity. So I think there was a point in the chat earlier that management are the only people to get access to equity, whereas in other companies it's all employees. And you can go right through to different design around how you treat leavers. So good, bad leaver clauses are a very common area where companies will try to express one philosophy versus another. I've known some companies who take a very company-friendly view towards leavers. I knew one chairman of one company who said the only good leaver was a dead leaver, and believed that unless you were there for the exit event, you had no right to equity whatsoever. And so any voluntary leavers or terminated leavers prior to that point would essentially lose all their equity. That's a very extreme definition of a bad leaver. And I think most companies today take a much more employee-friendly view, and do so in order to foster a culture at the company that values equity right throughout the life of the company.
We have another good question here from Erwin, which is, how often do you need to reevaluate the strike of options granted to employees?
So again, there's sort of 2 points there. One is around tax, and then one is around philosophy. So on the tax point, for example, in the UK, for EMI, you need to get a valuation for the exercise price every time you issue them. And so companies typically issue them in batches, and there's a window where that valuation is eligible. And so many companies I know will do that twice a year, sometimes more often. And then at that point, you're adjusting the exercise price in accordance with what the tax authority will approve. There's then also a philosophical point, and I know that some companies will try to seek the lowest possible exercise price permissible. And again, specifically within a UK context, there is a positive consequence of doing that. With many of the tax-advantaged UK schemes like EMI and CSOPs, there is a requirement on somebody leaving the company to exercise their options within a very short period of time, between 90 and 180 days, depending on the scheme. So what that means is that as a leaver, you have to stump up cash to buy your shares, or you lose the right to the options. And so in terms of making the scheme employee friendly, you want the exercise price therefore to be as low as possible. So it's as easy as possible for a leaver to buy their shares. However, some companies don't want to be employee friendly. They have a philosophy, as I say, that has that mindset of really wanting to use options as a retention lever, and therefore not make it easy for leavers to access those options as a sort of stick, so to speak, to keeping them at the company, and therefore they'll want to try and keep the exercise price as high as possible.
Does ego potentially play into that as well? obviously a lower exercise price makes the company seem less valuable. A higher exercise price makes it seem.
It is a very difficult point to communicate to staff, which is when you come into the office or you come onto Slack and announce, "We've made the company less valuable in the eyes of the tax authorities. Congratulations, everyone, we're worthless." Because it is a completely different mindset to the one you'd normally trying to communicate, and this comes to some of the really difficult communication points around options, because they are just quite complex financial instruments. And if your philosophy is to issue equity to everyone in the company, you really have to have an amazing communication plan, because there are lots of difficult nuances within the way equity schemes are structured that you have to get across to your team. This thing that a low exercise price is good, and in the eyes of the tax authority the company is worthless, is good. That's a really confusing thing to understand. And multiple other confusing elements that you need to get across. And then of course you've got to consider how you communicate different schemes to different people across multiple countries. So if you're a pan-European company that has a scheme in the UK and in Denmark, for example, then communicating the differences between those two becomes challenging.
For those companies or representatives of those companies here in the audience today who are in the not yet category, they haven't yet set up equity, what do you need in place in order to do it?
So I think one of the most common mistakes that companies make when they're setting up schemes is giving away too much equity. So it's very common from other CFOs that I've spoken to that they didn't really have a framework in place for how they would issue equity, and therefore they ended up giving away too much too quickly, and then quickly ran out of option pool. So one way to handle that, and it's the way we operate at Capdesk, and it's the way I've operated at other companies, is to have a very clear equity compensation framework which aligns with your cash compensation framework. So for example, we have a very transparent equity calculator that awards standardized grants based on salary and seniority level. And we have a principle that everyone at the company gets equity, but you could obviously cut that any way you like. And what that means is that as a hiring manager, it's very easy for you to bolt on an equity package to an offer. And likewise, when it comes to salary reviews or promotions, it's very easy to bolt on equity to that package. So in terms of communication, it makes it very straightforward. In terms of planning, it makes it very straightforward. It also helps with budgeting. So it's important to think about equity budgeting in the same way that you would with cash budgeting. There is a limited pot of equity that your shareholders have approved, and you need to extract the most value from that budget. And so, for example, what we do is we create a forecast for how much we're expecting to spend from our option pool based on our headcount forecasts, the various budgets that we have assigned to that headcount, and therefore the expected amount of options issuance. So it just allows us to have a very transparent conversation with our board to say, okay, you approved this financial budget. By the way, alongside our equity framework, you've therefore also approved or should approve this options budget. And that allows everyone to be very clear about when the pool will run out, and therefore when we need to start having conversations about option pool increases.
Is the company's stage particularly relevant? When is the right time to introduce equity?
So I think as early as possible is if you believe in the value of equity in aligning employees and motivating employees, then you want to do that as early as possible. And what we tend to see is option schemes going in around the Series A level. And that seems to be the right tipping point where the costs of putting in place the scheme are justified by the headcount in the company, and the aspirations for growth. So typically that's about the right time to do it. The question then becomes who gets what, and I think that's where having a very clear framework is important, and trying to find as much benchmarking data as possible. There are some really good benchmarks out there. So I know VC firms like Index Ventures and Balderton both have really good options planners, but they're not gospel, and you should definitely try to find as many different sources as possible. I mean, we published a big report on option pool data earlier this year, which was based on information we've gathered from our customers. And we found, for example, that option pools in reality are a lot larger than the VCs say in their standard benchmarking reports, which is an interesting insight into how VCs like to frame the conversations around cap tables, but also just helps give companies an expectation of what's normal when it comes to option pool size at different stages.
We have a nice, I think broad, but a nice question from Valentin. Has the pandemic changed equity management? And is anything going to be different moving forward?
I think that's a really good question. I think certainly it has. Well, there are a couple of trends we've seen as a result of the pandemic. I mean, one is that remote work has increased the number of countries where a typical company will have employees or workers. And that gives rise to all kinds of interesting questions about how you offer equity to employees across multiple countries. The pandemic has also seen a massive surge in the amount of capital invested in tech companies, and the valuations of those tech companies. And as a result, anyone who was sitting on options in tech companies pre-pandemic has seen a big increase in the value of those options. And likewise, the value of new issuances is going up. So clearly there is being an increasing trend towards options issuance. So yeah, so I think those are sort of two trends that I would observe as a result of the pandemic specifically. But there may be others, and I'd be curious to know if any audience members have observed any trends specifically as a result of the pandemic.
But obviously, as you kind of hinted or stated, the more remote employees you have, the more complexity you're going to have in terms of equity issuance, I imagine. Tax-wise.
Yes. Absolutely, yes. I mean, it's been in my experience, you know, and sort of straying slightly into the people ops side, the growth of remote working has been a huge benefit and an enormous curse. You know, the huge benefit has been that, you know, companies can now tap into global talent markets, and many employees are happier being able to work in a country of their choosing. You know, again, just from personal experience in Capdesk, you know, we've had multiple internal movements between countries as a result of the freedom that flexible working brings. The huge curse, so that's a huge benefit in terms of employee retention, and I think equity will only enhance that element of employee retention. The huge curse of that is, as you say, increased complexity, and that's both the case on the payroll and employment compliance side, and then yes, absolutely the tax side when it comes to different schemes. And certainly our strategy has been to set up different schemes for countries where we have a minimum number of employees, and that's where the fun begins, because then you have to be able to create a communication strategy that allows you to help employees in different countries understand those different schemes.
Another question from Felix. What do you see as best practice for giving additional grants for promotions or outstanding performance? If you give out 4-year grants, would you give them a new 4-year grant after the initial grant?
So in my view, best practice is, coming back to what I was talking about earlier, have a very clear framework that aligns equity compensation with salary and cash compensation, and then consider increasing grants in the same at the same time as increasing salary or other cash-based compensation. Because in my view, equity works best when you're constantly aligning an employee's expectation that their whole compensation package includes an equity component. It's just a part of their compensation that's bringing them into long-term alignment with the company. So I wouldn't wait for a 4-year vesting period to end. I would be looking to add top-up grants on an annual basis in line with promotions or pay rises that are also happening on an annual basis.
But would those happen on sort of a one-off basis? So you'd get the top-up as a promotion, almost like a bonus in terms of equity, or would each top-up have its own 4-year vesting period?
So I personally would have those top-ups have their own 4-year vesting period. And the advantage of that is that it creates a sort of rolling 4-year incentive. So, as you get several years in, you've got multiple option packages that are vesting and always giving you that incentive to stay 1 more year. So obviously we don't want to lock people into employment that they're unhappy with, but just creating that sense of 1 more year is an attractive nudge to keeping someone on the right side of retention.
But as someone who might like to track those rolling equity, that rolling
Awards.
equity, this comes back to your point that you made earlier on about the ability to be able to log in and actually track something. Trying to do that in a spreadsheet or by keeping notes in my diary is just absolutely not going to happen.
Absolutely, yes. Look, so I can't just sit here talking about Capdesk. Other systems are available, but I think whatever you do to make the most of your options pool and the grants you're making to employees, you have to have some system, some portal where the employees can log in on a regular basis and just remind themselves, okay, this is what I've got. This is what it's currently worth, and if I stick around for another year, this is what I will have, and this is what it could be worth. That just again keeps the employee tied back to the sense of the progression of value and the way their actions can pay off.
And just to go back to that very specific point, looking ahead 1 year, projecting what it would be worth, let's say in Capdesk, would you be projecting that based on the strike price as of right now, or would you also be projecting a new strike price?
Well, so the strike price of the awards that you've received are fixed, aren't they, for the life of the option? But you raise a really good point, which is how do you communicate the value to employees? And I think this is an area that again comes back to your communication strategy. In my view, the best thing to do with employees is to strike a balance between simplicity of communication and honesty of communication. And that's a really hard balance to strike with options because they are very complex financial instruments. And you're trying to forecast several variables, all of which have many degrees of freedom and large variances around them. But the way that we try to strike that balance is through scenario analysis. So we say, here are 3 scenarios for how the value of your equity could change. There's the bad scenario, because let's be very transparent to you, there is a waterfall within the company's capital structure. There are shareholders that have preferences over your options. And there is a scenario where the company's value could be less than that preference. And so your options could have no value. Let's be really transparent about that. But then there's also a scenario where the company performs higher than expectations. Maybe some big competitor from the US comes and buys us up at some outrageous premium. In that scenario, that's sort of reasonable best case, this is what your options could be worth. And then there's the sort of central management case. If we're operating according to plan, this is how we would expect the options to develop. I think that gives people just some kind of flavor for what the future could bring. And of course, even better if you're able to put that alongside regular secondary transactions where people are actually seeing their friends and colleagues realizing the value of their options.
Excellent, thank you. 2 questions from Joaquin. What do you think is the usual percentage of equity for employees, brackets phantom shares, in the FD cap table?
17%. So that's a very precise number, and Joaquin, that's because we did some research into this at Capdesk earlier in the year, and we looked at the hundreds of companies on using our platform, and we're able to see what the average is. And if you're interested, you can Google. I think Capdesk options report. I'm sure we can find a way to circulate this afterwards, and you can see how that varies by over time as companies go through the different stages of A, B, C, D funding rounds, etc.
Excellent. Second question, do you consider it standard to establish a permanence period for the beneficiaries after a liquidation event before the phantom shares are paid out?
So that's a question I would need to defer to a phantom shares expert. I'm afraid that's not me.
Okay, no problem. Very helpfully, Caroline has shared that report in the chat. So thank you very much for that, Caroline.
Thanks, Caroline.
Let's go on. Oh, so I was just really interested. I know we will have touched on a bunch of these as we've gone, but are there any common mistakes you see when fast-growing firms set up or expand equity?
Absolutely, yeah. So, I mean, as I mentioned, the most common mistake is awarding too much equity to early employees. And so, yeah, I can't stress enough the importance of having a really clear equity compensation framework in place before you begin a program like this. The next big bucket of mistakes are all operational. And so this will vary a lot depending on which scheme that you put in place. But certainly for the EMI scheme in the UK, there are just a ton of little mistakes that companies make all the time that can then invalidate those schemes or create huge expenses for the company at a future date. So, for example, very obvious one, not signing something called a Section 431 election. That can cause income tax to be liable when companies sell, when employees sell their exercised options, when they were expecting a capital gains tax rate. And not only that, companies can also end up with employee national insurance liabilities, which they weren't expecting, which in the most extreme cases can bankrupt the company. So, little mistakes like that on the operational side can give rise to really huge liabilities, and that's the case across multiple schemes.
Okay, thank you. Now we have a question about specific business law firms you would recommend for assisting with legal tax questions. If that may be a difficult one to answer because it will all depend on where you are, Nael, but are there things that you would ask a potential business law firm who you might be looking to engage related to cross-border equity issues? How would you identify the right firm?
Yeah, so if you were just setting up a scheme in one country, I would be happy to go with a local specialist that is relatively cheap. But if I'm doing something cross-border, then you need to be going with one of the larger law firms who are able to pull on either colleagues in the firm in different jurisdictions or trusted partners in different jurisdictions. The legal and tax complications in equity get big quickly, and so I would really be looking for a well-established law firm to support there. That is more expensive, but unfortunately, that's the expense that arises with complexity.
All right, I want to just let everybody know we've got about 6 minutes left in the conversation, so please don't be shy. We've had fantastic questions already. If there's anything burning that you'd like to ask, please get it in. I wanted to ask again, we've talked a lot about good communication. It's very clear that that's vital. Is there anything else that that companies need to think about to make sure that employees are seeing the value of their equity?
Yeah, I mean, as I say, beyond good communication and case studies, you know, there's no better case study and no better way for an employee to realize the value of their option by seeing a colleague or friend realize the value of their option. And so I think that's where showing a tangible link between the option and cash is key. But communication can carry a lot of that load, and you know, as the number of options winners across Europe increase, I think more that there is a growing culture shift in employees' expectation of equity as part of their compensation package, as they see colleagues in other companies or friends in other companies realizing equity value. And so I think, yeah, those stories can go a long way.
And if we have companies who are preparing to be acquired or preparing to go public, even perhaps even more exciting, I don't know, what do they need to think about?
Yeah, so the going public journey is a really exciting one, and you know, certainly it's one that we at Capdesk have been learning more about through our relationship with Fidelity, one of our investors, and I think there are some really quite substantial differences between the way equity compensation schemes are structured in the public markets versus the private markets. So, for example, in private markets, it would be very uncommon to have performance conditions attached to equity vesting. But in public markets, that is completely standard. So these long-term incentive plans that are put in place for CEOs and management teams of public companies very commonly have revenue-based or share price-based performance incentives, and there are the scheme rules around those public equity plans are typically much more company friendly than in the private space. So, you know, much tougher good bad leaver provisions, many more options for clawback or even discretionary adjustments from the boards of public companies. And of course, the options available to structure those schemes are very different. So, you know, you're not able to access the EMI scheme, for example, as a public company. So it does require a whole new set of thinking and planning if you're on that very exciting journey to being public.
And last question from me, as a CFO who's kind of positioned, obviously you'll have a close relationship with investors and with the board, but you're the CFO of a company, and what we've been talking about today is using equity as a way to increase or maintain employee engagement and employee investment. Is there a balancing act between your responsibilities to the board and your responsibilities to the employees?
Of course. So, you know, the board are there to represent the interests of shareholders, and a primary interest of shareholders is not to be diluted. And so they will often look at employee option programs and think, you know, why are we giving away all this equity? Why can't staff just work for the salary that they're paid? And, you know, I think that is one of the very common sources of tension between investors who like to think of companies as little machines where you feed in money and more money comes out the bottom, and management teams who know that companies are networks of people that you have to motivate and incentivize and retain on your team. So it's a very difficult balancing act for CFOs and CEOs to have these conversations with boards and directors and shareholders. Sorry, I think to have those conversations productively, it's important to have a balanced board, a board with directors who really understand how teams work and how incentives work, which unfortunately is not always the case. And then likewise for management teams to recognize that you know, investor incentives and investor preferences are all around share price growth. And so in my view, equity is one great way of equity schemes for employees are one great way of bridging those two incentives, because suddenly both employees and shareholders are all getting the same thing, or all want the same thing, which is share price growth. So it's back to one of those very common sources of disagreement between shareholders and employees, and I strongly believe that equity is one way of solving that disagreement.
It's actually a point that came up from a conversation we had during our CFO Connect Summit. We spoke with Alka Tandon, who leads the finance at Gainsight. We had a very similar fireside conversation, and she said the number one piece of advice that she gives to CFOs is to choose your investors wisely, to the extent that you can, as always.
Yes. Yes.
Because there's no good deciding that philosophically as a business, employee equity and employee ownership is the number one thing, if investors feel that investor ownership is the number one priority.
Yes, and I think it does take mature investors to recognize, in the same way that it takes mature entrepreneurs to recognize that it's better to have a smaller slice of a bigger pie than a big slice of a small pie. And you know, if you're aligned on the philosophy that says issuing equity to employees drives an ownership mindset, that means every decision an employee makes is made through that prism of how do my actions increase shareholder value because I'm going to be a shareholder, then I think there's a very natural alignment at that point between board, shareholders, and management team. But as you say, you've got to pick your investors wisely.
I think that's a wonderful place for us to leave it. Greg Carter, I want to thank you so much for your time, for all of the wonderful advice, for answering our questions. Just thank you very much for being here with us.
Not at all, Patrick. Thank you so much, and thank you so much to the wonderful community who've brought all these questions forward.
Fantastic. We will see everybody again in the new year. If you are taking time off, have a wonderful time off. I hope you are getting at least a little time off. And otherwise, we'll see you in the new year with our next live event. And just look out for more from CFO Connect. Thank you all very much.